to the first and inaugural episode of Managing Your Money with Pekin Hardy Strauss. I'm Adam Strauss. I'm here with Josh Strauss, Ted Suling, and Matt Bloom. And we're here to talk about whether the United States economy is heading into a credit crunch. A few months ago, there were 3 bank failures. Silvergate Bank went under, along with Signature Bank, and of course, Silicon Valley Bank. And then in the most recent earnings report, First Republic Bank, just a couple of days ago, announced that they had seen their deposits decline by about 40%. So it seems like there are at least some small and regional banks that are having challenges. And then on top of it, we're seeing a lot of news about office towers that are being sold for very steep discounts, or where the owners are handing their keys into the bank. And so it also seems like there's some problems that are brewing, at least in the office section of the commercial real estate market. So, I guess I want to just sort of open up the conversation before we take a look at a couple of charts. What do you make of what's going on?
I'll start. I mean, I think to a certain extent, what has happened to these banks is a little self-inflicted, and to a large extent, it has to do with the Fed raising rates at a very fast pace. I mean, in the case of Silicon Valley Bank, for example, this company had no risk officer and invested. It took in a humongous amount of deposits starting in 2020. And put them to work at very low paying treasuries, and all these interest rate moves has really impacted their balance sheet. And then their deposit base was not very sticky, and they disappeared in internet time in 36 hours. Today it's Thursday, April 27th. I mean, if First Republic makes it the next week, I'd be surprised.
Right.
I think we're going to see them I think we're going to see them taken over in the relatively near term based on the earnings report this week.
Right. And, if you look at the chart we have here that shows the trend of the growth rate of deposits, it's negative. And I think it's last time that the growth of deposits was this negative was during the Great Depression. I mean, it's been a very long time since you've seen this kind of decline in deposits. And it may be because we have a couple of banks that have literally gone under, but I think it's also because investors are seeing the deposit rates they're receiving from these banks and are moving into money market funds or buying short-term treasuries because they're getting a better return. And so, Josh, I know you mentioned that Silicon Valley Bank didn't have a risk officer, but I don't think the problem was a credit problem, really. I mean, it was an interest rate problem, right?
Yeah, in that case, for sure, right? I mean, if you're looking at the 2 versus the 10-year Treasury, the yield curve is so inverted. It is, if you look, which has nothing to do with credit. I mean, in terms of the quality of credit, I mean, this is just treasuries we're talking about. Credit spreads, whether it be investment grade or junk, are still within, reasonable levels. This is all about interest rates, to your point, Adam.
Right.
And the banks are between a rock and a hard place. They right now you can get 5% on 3 to 6 month paper, treasuries. If you wanted to, and which is that number is much higher than the earnings rate for these banks. So their choice is to either one, charge a lower rate than the 5% in order to have a positive spread, and then watch assets disappear like they have been for First Republic and other banks, or 2, they can offer higher yield and then watch their profitability go away. And you just
get hammered
with the 2 versus the 10, you just haven't seen this much inversion. You've seen it twice since this inverted since 1934. I think you might have been referring to the 90-day versus the 10-year, which is even worse.
Right.
And that's why the yield curve can't last.
Well, clearly, what we're seeing right now is a challenging environment for banks. That happens anytime you have an inverted yield curve. And I think the question that I think is an important one to try and figure out, and why we're here, is what does that mean for larger economy? What does that mean for markets? Ted, I'm looking right now at this chart going back a year between the S&P 500 index and the S&P Bank ETF, and basically the index over last year is flat, whereas the banking index is down 24%, and they were moving together, and I think generally moved together, up until I don't know, I guess until these four banks or these three banks failed. So I guess is this sustainable for the S&P to keep performing while the bank index is down at a significant low?
Yeah, that's a really good question. I mean, the S&P has been heavily weighted with tech companies, things like that, which had a little bit of a run at the beginning of this year, things along those lines. So I don't think it can necessarily sustain this gap that it has right now, but there is going to be some feeling in the S&P of downward movement. I can most likely see that because of all the bank stuff going on.
You have to assume that at a certain point, the credit tightens in the rest of the economy, because the banks can't survive in this type of an interest rate environment with this deep inversion. They can't survive like this for very long. And it eventually has to spread throughout the rest of the economy. If banks are tightening credit standards everywhere because lending is effectively unprofitable, you have to believe that it's going to have an impact on the rest of the economy at a certain point. It can't stay isolated to the banking sector.
It's very true.
And I mean, we've seen large cap banks for the most part do okay. They're not as depressed as some of these small regional banks. And my understanding is that the small regional banks really focus a lot of their lending to the real estate sector and to small businesses, small and medium-sized businesses. So, I mean, is it possible that we could, Josh, you think is it possible we could have like a credit crunch in sort of part of the economy where small and medium-sized businesses see their credit pulled, and perhaps some real estate investors may have a harder time getting credit than they otherwise would have, but the rest of the economy doesn't see that same kind of problem?
Well, I haven't thought about it in that respect, to be truthful. But the cost of extending credit for the large mega banks is certainly a lot less than the regional banks, because they're not seeing those kind of deposit outflows, because the world views them as too big to fail and a good place to leave their capital. While, if Silicon Valley Bank, which had $200 billion in assets the week before it crashed, was also looked at as a relatively stable place at the time. So to answer your question directly, yeah, you could see it where, the bigger companies could have an easier time getting access to credit because they're more stable businesses than smaller businesses. I think that typically happens in recessions. You'll see more bankruptcies for small businesses than you for larger.
Right.
I wonder, and that's part of the reason why small caps have underperformed this year versus large caps. It's reflected in that, I should say.
Well, just to this point, I'm looking at this chart that shows the triple B option adjusted spread. Matt, can you interpret this chart for us a little bit? What is this chart showing, and what do you think it means?
Well, certainly right now we're not seeing general stress in the credit world. The spread is still fairly close to the historical average, which basically doesn't indicate that there's a lot of stress right now. But I don't know how we see it stay here. especially we have a lot of different things going on that at least are starting to indicate that the economy is slowing down. Then obviously all this bank stress isn't helping. So I just right now I don't think that investors are getting paid to take credit risk in the corporate space. When I can go get a short-term treasury and make over 5% on that, and then I'm getting such a small premium to own credit risk. I don't see why I would want to do it. So I think that credit spreads are going to have to widen at some point here. I don't see how they stay here in these sort of nice, historical average levels.
So what you're saying is even if we're not seeing a credit crunch in the corporate bond market right now, you foresee one coming, and therefore corporate bonds are perhaps a little bit dangerous to be buying right now at this point in the cycle. Is that what I'm hearing you say?
That's my position on it, because I don't see there's sort of no reward for the extra risk that I'm taking, right? It's a very incremental little bit of yield that I'm getting on investment grade corporates when I can own risk-free treasuries and make my 5%. In fact, I think that this level of treasury yields is dangerous territory for the corporate space.
What's going to cause these yields to go up, Josh? What are your thoughts on this chart?
You're talking about, you talking about credit spreads, or are you talking about
the
treasury
option
yields
adjusted
here?
spread, which I agree with Matt.
Spreads.
I
Okay,
mean, it looks like
okay.
it's to me like bond investors are relatively sanguine about what's going on right now.
Yeah, I think that's true. I think that, given how the stock market, the bond market has behaved this year, I don't believe that people are really paying attention to the risks associated with this. It seems a little like the calm before the storm. I mean, if you were to compare, look, the spreads are the spread that you would get owning junk relative to the comparable maturity treasury. But with the yield inversion, the difference between the 3-month treasury or the 6-month treasury versus the whole yield curve of junk or investment grade corporates, super tight. It's to the point where it was this tight in 2007. It was this tight in prior to other recessions. And to Matt's point, you are by buying corporate debt, you are assuming that these spreads are not going to widen out, and you're simply not paid for it. And this is a time to sell some long dated junky stuff and upgrade the quality of your portfolio. Because if you do that and you're only earning 5%, in treasuries, it's the most liquid market in the world, and you're not going to see a credit spread event. But the counter to that is, of course, there's that tail risk event, which is super unlikely to happen, which is a breach of the debt ceiling, right? I mean, I don't believe that's going to happen, but there are indications that there are some market participants that think that risk is actually out there.
And what is that? What bearing does the debt ceiling have on the likelihood of some kind of a credit crunch going forward? Help me connect the dots.
If we breach the debt ceiling, all bets are off. I mean, strap on your seatbelt and make sure you own gold
for everything.
In that case. What?
Yeah, you don't want to own anything but physical gold.
In that case, correct. And historically, Congress has been aware of that fact, which is the reason why the debt ceiling has been increased dozens and dozens of times over the years. I think it's been like 90 times since 1935 or something like that. It's gonna get increased, but the concern here is that you have such polarization in Congress that you could see people taking political postures in order to gain political chits. That theoretically could happen, and that's part of the reason why you see that if you look at maturities for when the debt ceiling, around the time when the debt ceiling is supposed to expire, yields then are widening out. And those are people who say, I don't want to even deal with that risk. I'd rather own 6 to 9 month paper where I don't have to deal with this.
Right, but that to be clear, that's not isolated to the Treasury market, because if that risk of the debt ceiling, it extends throughout the entire bond market.
Well, and
it just feels right now like owning corporate debt is like picking up pennies in front of a steamroller. You're getting almost nothing for it, but you're taking on incremental risk in an environment where a lot of indicators are suggesting that credit is going to be more difficult to get going forward, that earnings are likely to be under pressure across the economy. It just doesn't seem like we're in that sort of environment where, you've got all these tailwinds. Instead, you've got a lot of headwinds, and yet you've got this tight spread. I just don't see why anybody wants to do it right now.
Okay,
let me give an
does
example.
anybody here want to make the counter argument that what we're seeing right now with the banks is a temporary phenomenon, that it's a tempest that's going to pass, and look, if you can get a couple points more than the Treasury owning corporate debt, why not?
You can get a couple points greater than the Treasury for comparable maturities. For the issue is that if you wanted to own, let's say, Johnson & Johnson paper going out 5 years, you're going to get 4.5%, while the 6-month Treasuries right now is 5%. So you have the benefit of the credit cycle, but you don't get the benefit. The inversion is problematic because investors aren't paid for tying up their money for longer periods of time, which is crazy.
Yeah.
So
let's not forget that we might not be done with interest rate hikes either, right? So
right.
why am I going to take incremental duration risk too? So you want me to take extra credit risk, and you're talking about taking duration risk. We might not be done with the hiking cycle. There's a lot of people out there that are acting like the hiking is all done, but Powell, he at least in public is acting like he's got more work to do. And so, I don't want to be sitting on long dated paper right now, with I'm getting a lower yield than if I own short-term stuff. And I'm taking more duration risk in an environment where we may see more rate hikes. That makes sense.
Right.
Yeah. And then think about FRC, right? First Republic Bank, right? I mean, First Republic has, there are assets coming out of that, deposits coming out of that and going elsewhere. And let me tell you, people who are moving their money from First Republic to JP Morgan, or First Republic to Wells Fargo, or First Republic to Synovus, or elsewhere, they're not going to keep it in an uninsured basis. They're going to put that money to work to make sure that it's not uninsured. They're going to go buy treasuries, right? And if you buy treasuries with it, then the banks can't access that capital and put that capital to work. So that's going to put a squeeze on credit. I mean, First Republic in December of 2022 had $213 billion in assets, $166 billion in net loans. And that's going away. That's going to go to zero. And that money's going to go elsewhere. And if all that money gets poured in treasuries, you're going to see lower treasury yields, and you've got to offer far higher credit spreads in order to entice investors than what you're getting right now.
Yeah, I mean, I think it definitely does seem like a very
cost of credit. I was just going to say higher cost of credit. It's going to be, painful for the economy. It's the cost of building new factories is going to go up. The cost of building new warehouses is going to go up. The cost of entering any kind of new product areas is going to be more expensive for everyone. And so as a result, it's going to have a deleterious impact on economic growth. And in the meantime,
just rolling over existing,
we can earn 5% by owning short-term treasuries with total liquidity. If the market sells off significantly and I want to deploy the capital, I sell it today, no impact on price, go put the money to work elsewhere. Then I'll take some credit risk, but I'm getting paid.
All right, Matt, you get the last word, and then we're going to wrap up.
Well, I was just saying that, there are a lot of different problems here. In addition to what we're discussing with the tightening of credit because of the pressure that's on the banks, like we have totally disregarding that. We have a lot of corporations who took on a lot of debt over the last few years, right? Not just corporations, but also governments, individuals, et cetera. And all of that debt, it's getting rolled over and refinanced at higher and higher and higher rates. And as we see that continue to roll off and get refinanced at these higher rates, that alone is a huge stress on the economy, right? It's going to crowd out, a lot of spending because that money is needed to pay back debt at enormous amounts of debt that were racked up at higher and higher rates. So I see a lot of pressure on the economy that doesn't get reflected in any of these, like in the corporate spreads, et cetera. It's just not showing up there yet.
Okay, well, that pretty much concludes our first episode on, are we heading for a credit crunch? We're going to try and do periodic videos like this where we talk about a different topic. We haven't figured out yet what our next topic is, but if you're watching this, thank you for doing so, and we'll see you again sometime soon. Thanks.